Welcome back to another episode of Rail Industry Connected. I'm Dan Clark, and thank you for joining us. Network Rail's Control Period 7 kicked off in April 2024, with £44 billion made available to the organisation for the next 5 years in order to provide a boost to safety and reliability. 12 months on, or 20% through the control period itself, and industry figures are warning that too little rail work is flowing through to suppliers, with many citing a slow start to CP7 as a reason for less than anticipated revenues so far. In time, many are worried that a lack of work will lead to further redundancies and potential business closures. Today, we speak to Christian Fry of Carter Fry. Christian is part of a team that helps businesses grow and has completed some analysis on CP7's impact on the supply chain in its first year. Posted recently on LinkedIn, Christian's analysis highlights some of the stark realities that the industry faces and potentially will face, and we are delighted to speak to him on Rail Industry Connected to discuss this further. Christian, welcome and thank you for joining us.
Well, thanks for inviting me and thanks for having me, Dan.
Thank you very much. So you've developed this analysis about CP7 spending so far. For those that haven't seen it yet, please tell us the background of why you've developed this analysis and why it's useful for rail businesses so far.
Okay, yes. So it's a bit of background. I've about 30 years experience in the rail industry, held various jobs in that time, roles in engineering, strategy, innovation, and work winning. And about 12 months ago, I decided that I wanted to start a new chapter in my career, as it were, and felt that there was a gap in the market. So for the past 6 or 7 years, I was heading up work winning within Alstom, and we used to subcontract certain pieces of work around work winning to various suppliers, and I felt that there was a gap in the market, in that you could hire bid writing companies and bid managers and people to help you to win work. But actually, if you don't get the strategy correct from day one, you can have the most well-written tender in the world, but you're not going to win. So what I felt was there was a gap between strong strategy with creativity and effective proposal development. So we formed Carter Fry, myself with my business partner Jessica, and started work about 12 months ago. Our first clients came to us around about July time last year, specifically asking us to help them look at the UK rail market and how they could develop their rail growth strategy, which got me into starting to look at some of this market data and what was available out there. So I started delving into the numbers that Network Rail publish on their website through the transparency work that they do. So every invoice that's above £25,000, they publish the details of that monthly. And what I did was, in helping these organisations to understand the market, the way it's structured, how large it is, and where best for them to compete, I started aggregating all of this data and starting to analyse it and look at, the structure of the industry, the level of concentration, the level of spend, and really use that data to start to pinpoint some effective growth strategies for those organisations. So that's what started this interest in the data. But around about the same time, I started to hear noise in the industry about organisations finding it particularly challenging in CP7. Lots of suppliers struggling, and then I started to see one or two companies. Or one or two business failures in companies that you'd expect to survive, long established businesses. So I started looking at this data and wondering, there was Network Rail still spending a significant amount. If you look at the first 10 months of this control period, they've invested £6.4 billion with suppliers. And yet, so huge amount of money being spent, but still these organisations are struggling, and the noise is, it's pretty loud in the industry. No matter where
Yeah.
you look, you're hearing stories of organisations struggling. So I wondered if there was an explanation in this data as to what the issues were. And the first thing that struck me when I looked at the data was just the level of concentration. So, of that £6.4 billion that's been invested in 10 months, 88% of that has been with just 10% of the supply chain. So that's just a really, really concentrated market. And, from my own experience in business strategy, I know that concentration is not necessarily a positive thing in markets. Highly
Of
concentrated
course.
markets tend to have lower levels of competition. There's less pressure generally on pricing. Suppliers tend to have a lot, or dominant suppliers have a lot of power in that relationship, and you tend to see high market entry barriers within markets which are very, very highly concentrated, and therefore kind of innovation tends to be lower. You get a lot of stagnation. You don't get the continuous improvement benefits that you might see in a more competitive landscape, and as a result, um, you get a lot less resilience in the supply chain.
Mm.
So my thought was, I've got all of this data at my fingertips that I've done, and I'm hearing lots of people talking about the difficulties and the challenges that they've got. Can I help them to, one, understand what those challenges are and why they're occurring? And then also, well, what could they use that data? How could they use that data to better inform their strategies so they make better business decisions, and hopefully navigate this period of difficulty and challenge that we're seeing today. So that was the background really as to why I'd done the analysis in the first place, and then why I felt it necessary to share it.
And what have the results shown elsewhere so far? You've noted that 88% of the spend has just been with just 10% of suppliers. What else has your results shown?
So yeah, the it's not just yes. Whilst that data is showing a very, very high level of concentration across the whole supply chain, what is insightful is that actually, while £6.4 billion is a huge amount of money, actually, if you
Mm.
compare that with spend in the first 10 months of last year and the first 10 months of the previous year, then in real terms, that's an 11.4% drop. So overnight, you've had a
Significant.
drop of over 10% in the size of the overall market.
Mm.
But then, if you dig deeper and start to look at the individual asset categories, some of them are faring much worse than others. So, for example, if you look at some of the areas where Network Rail spends the most each year, for example, signaling this year has seen a 24% real terms drop
That's
versus the
huge.
previous year. And that's in
Mm.
a market where the concentration, so the four biggest companies within the signaling supply chain, they get 82% of the spend. Yeah. So
Wow.
you've got four companies, and one of them in particular, Siemens, is 50% market share. So 50% of all of the money that Network Rail spends on signaling goes to one company, 82% of it goes to four of those companies. And yet overall, there's been a 24% drop in spend. So the impact of that, the concentration levels remain fairly stable. It was pretty much the same the year before and the year before that. But what's changed is the overall spend. And I think, and we'll dig into this a bit more as we go through this, as to what the impact of that is in the wider supply chain. So signaling's a big loser. But if you look at
Mm.
track, for example, track's actually seen a nearly 12% real terms increase over the last 3 years. So the level of investment that's going into track renewals is very high. Again, it's a very, very highly concentrated market in that of the money that Network Rail invests in track, 85% of that goes to the four largest um, organizations. But that's not really a surprise because you've got those rail systems alliances that have got three large framework contracts. And so if you actually look at the data, there's no one supplier or group of suppliers that's got the same level of market share that there is in signaling, for example. So, the number one supplier in track is the Southern Rail Systems Alliance at the moment, and they've got around about 35% of the overall market. So it's slightly lower. Um, then, if you start to look beyond track and signalling and we go into civils, there's been another big, big drop in civils expenditure. So that in real terms is down 13.75% versus the previous years. However, the concentration ratio in civils is much, much lower. So the four largest suppliers in civils only have 44% of the overall market share. So it suggests that that is a much more competitive market overall. And the number one supplier at the moment, which is Amco Geffen, is only got a 15% market share. So actually that looks like a pretty competitive market, albeit it's a market that shrunk significantly in the first year of CP7. And the other two areas that I've looked at are buildings and E&P, electrification and plant. Um, those two markets have both shrunk, albeit a much smaller level. So in buildings, it's a fall of 2.2% in real terms, and in E&P, it's 1.5%. And both of those concentration ratios, certainly in buildings, it's 45%. And the largest single supplier's got 19% market share, and that's Murphy's. In E&P, 65% is the four firm concentration ratio, and Amy is the largest of those suppliers with currently 22% market share. So, what the evidence is showing is that whilst there is a high degree of concentration, it is not the same in every category, and also the drop in spend is not evenly spread across different categories. It's different, and so different parts of the supply chain, I think, are feeling different pressures and different pain depending on which asset category they are supplying into.
You can see that from the response from the industry so far. There is such a varying view as to why things aren't going well, especially from an SME perspective and the wider supply chain at the moment. And I think from the analysis that you've shown there are some emerging themes, concentration being one of those issues, um, which from a longer term point of view, if you have a set concentration of companies, as you say, less competition, but also impact on those businesses that are also competing or would have been competing in that market because they will lose staff, they'll lose revenue, and obviously a huger impact on those companies. Um, Alongside that, we've already got a skills gap issue as it is, and when you look at the levels of spending dropping, 10% is still a significant amount of money, in terms of drop. So we've always acknowledged from previous control periods that there's been a level of fluctuation during those 5 year periods. But it makes it harder for businesses to be able to plan effectively and recruit and train effectively. You think about signaling, you made the point about signaling there and the reduction in work. To
Mhm.
bring someone into a signaling environment, it takes years of training and
Yeah,
you will lose that experience very quickly if if the work isn't there. They will go to other sectors, and I think that's the underlying issues that are being caused as a knock-on effect, maybe as such.
yeah,
You've
yeah,
mentioned about this level of concentration, and the analysis shows that generally this is nothing new. It's been that way for quite a while. But what does this mean for SMEs? And in your opinion, what should be done to
yeah,
widen that concentration?
yeah. So First of all, you know, I'm not surprised that there's a high level of concentration in the market. If you look at what Network Rail does, it's managing an enormous um, asset base, and having to deliver big schemes, big complex high value schemes. Um, we've seen over time that there was kind of like a disconnect between the value of the investment and the outcome that was being delivered. So we've seen Network Rail move to this idea of being an intelligent client or being a thin client and going towards outcome based contracts, and then pushing more and more work, larger value contracts down to its tier one supply chain to deliver. And to me, that's kind of natural, and what you would expect with this idea of how can they effectively manage the infrastructure and deliver the outcomes that they need to deliver. So first of all, I'm not surprised that there is that high level of concentration, and I think
Yeah.
it was okay when spend was going up. So when investment was on the upward trend, the big tier ones would always have a lag between their own internal capability and the demand in the market. So they're always running a slight deficit in terms of the headcount that they're operating with and the capabilities that they've
Mm.
got within their organization versus their needs. So there's always a lag. So as the market grew, the work trickled down and cascaded to the smaller suppliers and down to the tier two, tier three suppliers as well. So everything seemed to work. On the face of it, it worked while spend was going up. But suddenly, when you see a significant contraction in the market that we've seen at the start of this control period, suddenly there is too much capacity within those tier ones to operate the same model within those dominant suppliers. So they're faced with a real challenge of potentially, if they carried on subcontracting the work that they were subcontracting out historically, then they would face a significant underutilization within their own resources. And so the tendency is when you get a big contraction in the market, they start to self-deliver more and more of the work. And with contracts being target cost and outcome based, actually, it makes sense for them to self-deliver the work, because if you're
Does.
faced with the prospect of underutilized staff, or you get your cost paid plus a fee within the mechanisms in the contract, then you're going to choose to self-deliver. And so therefore, the smaller suppliers and the less dominant contractors, not only do you see a contraction in the volume of direct work that you could deliver for Network Rail because overall the spend has gone down, but actually you also get squeezed at the other end, because the work that you would traditionally do for the dominant suppliers, they now self-deliver. So actually the impact is far greater on the smaller suppliers than it is on the dominant large suppliers within the industry. So, which, given there are more people actually employed within the wider supply chain than there are in the dominant suppliers, it's a really like negative situation and an environment to find yourself in. Um, what can be done about it? Now, that's the incredibly difficult question, because
It
um,
is.
from a the available money is what the available money is, and as a country, we're facing more and more difficult investment decisions as to where the government invests its available funds. You've got competing, defence, health, education, and transport. So the reality is CP7 is going to be hard, and the amount of spend is going to be lower than maybe we've seen in previous periods. Um, I don't think there is a quick fix. Could um, could Network Rail do things differently? It could maybe consider more. To be honest, mentioned, that, well, from my perspective, from observing the situation, it's like Network Rail are saying, yeah, but we're spending 6.4 billion, and the supply chain saying, yeah, but we're not seeing any of it. And it's almost like you've got
Mm.
two groups of people talking in different languages, and so one just doesn't understand the other. And I think, could Network Rail take a more proactive role in making sure that it's managing not only the capacity of the industry to deliver the work, but also the skills that are required to deliver the work and to meet the longer term needs? Could they make some decisions around how work should be contracted to um, support those needs, as well as actually just getting the work done at the best possible price, possibly? Um, is there Could they look at industry structure? Could they look at the way certain parts of the industry are structured and the works are delivered? Yeah, absolutely. I think, certainly signaling is one of those industries where you look at it, and yes, the big companies are investing enormous amounts of money in technology and developing products for the UK or customizing them for use in the UK. And we're talking huge amounts of money that are required. And those companies do need to see a return. Could you come up with different ways of delivering? Yeah, absolutely. It could be done differently. You look at other similar high technology markets like telecoms. You don't necessarily have the technology providers are not necessarily integrating the systems and putting them together. There's maybe some changes that could occur in that space to widen the market. I think there's a role for industry associations to continue representing the entire supply chain, including those SMEs, and lobbying hard for making sure that the whole industry is heard. But without doubt, these are difficult times, and it's going to be difficult going forward. And I don't think there is an easy answer. Not if you are just looking at Network Rail. We'll come into some of the things that you might be able to do later on. But when a market is dominated by a single customer, and that single customer has less money to spend, then there is going to be an impact in the wider supply chain. Could they manage it better? Yeah, probably. But it is a difficult time.
And there's no quick fix, as you say. We've seen this before. We've seen this before in previous control periods. This is nothing new in terms of how the concentration is spread and how the spending is allocated and when it's spent as well. Why do you think it's affecting businesses more in this current control period compared to others?
Yeah, it's a good question, and one that I've been pondering. As you say, every start of every control seat, it's always feast and famine, and boom and bust. Every control period has been like that, but why does this one feel differently? I think there's a number of reasons why this feels slightly different to previous control periods. I think that the drop is bigger and for longer. So suddenly the drop in work from one control period into a next control period is longer. I think there's also been a number of shocks in the wider economy over the period of CP6. We've had COVID and such like. So there's definitely an overall negative sentiment in the country. There's shocks that have happened that I think have probably impacted the financial resilience of many companies. We've had the inflationary pressures, and whether or not that the contracts keep pace with the inflation pressures that suppliers are feeling, probably squeezing them a little bit there. We've had there definitely seems to be less new schemes coming to market at the start of CP7. There's a lot of talk about the spend that we're seeing at the moment being the hangover for CP6. So this is delivering schemes that really should have probably been delivered in CP6. They've run into
Mm.
CP7. That's eating into budgets for CP7, and it's also, affecting new work coming to market. Um, I think there's some big transitions going on. So there are structural transitions which bring in uncertainty. So we've got GB Railways coming in a couple of years, and that's affecting decision making, and it's affecting confidence, and all sorts of knock on effects from the whole uncertainty around that transition. There are technology transitions. So if you look at the signalling market in particular, CP7 was always going to be about a transition from conventional signaling to digital signaling. So there was always going to be sort of this move away from big signaling renewal projects to more of a patch and mend, and also, getting the industry ready for the rollout of ETCS in CP8 and beyond. So I think, if you couple all of these things together, the impact is really affecting business confidence, overall sentiment, and I think it's making things possibly feel a lot worse, and destroying confidence, which means no investment. If you've got other things as well, like the enhance at the start of CP6, there was an enhancements pipeline. It had been published, and
Yeah.
so there was visibility of work, not just renewals, but enhancements works. Over CP6, we've seen HS2 get cut back. We've seen Northern Powerhouse Rail stalling. We've seen lots of planned projects kind of stalling and delayed. The enhancements pipeline has not been republished in 5 years. So it's kind of all adding to this uncertainty, negative sentiment, and destroying business confidence. And couple that with, you're probably a lot less financially resilient now after COVID and the cost of living and inflation pressures that have happened in CP6. I think that there's less resilience in the supply chain. And so that's why I think it's probably worse this control period than it's been on previous control periods.
And as you mentioned earlier, the trickle down economics from the tier ones down is not being applied in this case. So the companies and the people feeling it most are, that wider supply chain. Um,
Yeah.
yes, so they are obviously going to struggle from smaller levels of funding to maintain their businesses, but from an opportunities perspective, this does look bleak for them. We've already seen companies reporting redundancies and potential closures and things like that as well. So, what can they do in the interim? We've acknowledged there's no quick
Yeah.
fix here, but what can SMEs do to overcome this challenge?
Yeah. No, you're right. It does look bleak, challenging. Certainly, if I was, doing my strategy work, I talk in terms of the um, total addressable market. So the total amount of spend that is coming down. You look at the serviced addressable market. So if I'm a supplier, how much of the market can I actually supply into it? Do I have the right products and capabilities? That is coming down. And then if you look at the obtainable market, which is of that I could service, how much of it can I actually get? And that's been squeezed from both ends. So in terms of those three characteristics that I would look at in doing strategic market analysis, all of those are negative. So what do you do about that? Well, I think, if I were these companies, I think you've got to look at diversification. So maybe, looking at diversifying your customer base. So are there other customers in rail markets that you could look to supply into? Are there different territories? Are there markets that you could supply into, like Ireland, for example, which is heating up? Various other markets around Europe that are heating up is it possible to break into those markets? Can you go into adjacent markets? I mean, we know that investment in utilities is increasing, investment in defence, investment in highways. Generally, not every market is seeing the same sort of downward pressure on spend. So is it that can these companies transition and diversify to give them more of a portfolio of customers in different markets and territories, which would help to smooth things out? So is it possible to do that? That's one area that you could look at. Is it possible to move up the supply chain? So can you move from being a tier two, tier three supplier, or a smaller tier one supplier? Is there a way in which you could move up the supply chain and start to challenge some of those dominant suppliers? And I think that's not necessarily something you could do on your own, but can you form a partnership with other companies in the sector to that the combination of the various companies, whether it's one, two, three companies coming together, actually becomes a viable alternative to a dominant supplier? Are there new operating models that you could look into, where maybe instead of being reliant on capital expenditure for the projects that you deliver, is there a different way of delivering works which is not necessarily reliant on capital investment? Can you move things from capital investment to operational costs? There's lots of things that you could look at depending on which part of the market that you supply into, and what skills and capabilities, technologies that you have. I would look at disrupting. When a market's shrinking, it's pointless being there with a Me Too strategy, because that market is getting smaller. So I think you've got to be disruptive. You've got to look at, can I use the term red oceans and blue oceans. So red ocean is representing like a bloodbath. Everybody's fighting for an ever decreasing amount of work and the pressure on margins, and it's a race to the bottom. Can you create the blue ocean? Can you look at the value that your organization delivers in the things that it does? Can you look at, what could you eliminate? What is it that you do today that you could eliminate? What could you reduce that's not important to the customer? What new things might you be able to deliver that would be really valuable to the customer, and create new sources of value? Or what things could you raise the bar on versus the competition? How could you set yourself apart from your competition so that you win a greater share of the work that is available out there? So I think there's work that organisations could do there. In terms of, if I look at the traditional way of growing a business, you do your market analysis, you come up with a strategy, you come up with your product, your service offering, your disruption, your innovations. Then you've got to message it and position it. And from what I see in the rail industry, I think we're terrible at that side of things. It's almost like we learn a language that's specific to our organizations, and we're all inward looking, and we talk, and we're really proud of the stuff we do and the great technologies that we develop, and all the great stuff. But then when we communicate it to the market, the customer doesn't actually care about those things. He cares about the outcomes that you're going to deliver. He's interested. If you look at Network Rail, they operate an infrastructure. So we need to better communicate our value. We need to better message and position our product offerings. And I think there's a lot that organizations could do to improve that. And, at the end of the day, people don't, even in big organizations like Network, right, people don't buy from organizations. They buy from people. They buy from people they trust. And so there's work that can be done on building relationships, on developing trust, and overcoming. I mean, we're all facing challenges, whether you're in the supply chain, whether you're Network Rail. We are all facing challenges going forward. And actually, there are opportunities in those challenges to build trust, build relationships, come up with new sources of value, and really change the game. And I think if the companies that do that are the ones that will succeed, that will get through this period, this challenging period. Those that just sit there and say, my market's shrinking, my business is in trouble, what are you going to do about it, Network Rail? Well, to some extent, their hands are tied. It's not, the
Yes.
money is not flowing down from government. So, you can't be a victim in all this. You've got to take proactive steps to address these challenges. And I think there are some opportunities, but look, it's going to be really, really difficult. It's going to be challenging. It's not easy. There's no quick fixes. And there's no one size fits all. So depending on your business, what you do, what capabilities you provide, it's going to be a different answer for different companies.
I completely agree with that sentiment. I think it is down to the industry as a whole to adapt, to diversify, as you say, and be a bit of a disruptor. So yeah, that is a good challenge and a positive challenge to take forward. However, I think one thing that is an important point in this is it will force supply chain businesses to diversify, which will naturally create bigger skills gap than we've seen or than we currently see, because people will leave the industry, they'll go to work in other industries, and those skills will be lost. You're talking about such specialist disciplines, signaling, going back to that as an example, that takes a long time to reinvest. What are the long-term implications for the supply chain and the UK rail skills base if there
Mhm.
aren't tweaks made to widen and support businesses develop
Yeah,
those people?
yeah. So yeah, you're absolutely right. The potential impact of this is existential for rail. From what
Mm.
I believe. So if you look at the rate of renewals on the network over the last 10, 15 years, it hasn't kept pace with the aging of the assets. So the asset base is getting older and older. There's already a skill shortage in terms of delivering the works that are planned. And I think the latest NSAR workforce survey from last year showed that, and this is even before the current situation really became critical, but that study showed that by 2030, the expectation is that 90,000 people will have left the industry out, and that's out of 220,000. So 90,000
It's a
potentially
huge amount.
leaving within 5
Mm.
years out of 220,000 in in a market which is not actually keeping pace with the renewals requirement is huge. And then you throw into the mix what's happening today with CP7, and actually that's accelerating the situation. So actually, I wouldn't be surprised if that 90,000 potentially you could get there even earlier than 2030 if the current
Mm.
situation doesn't change. Now, I think the risk for rail as a whole is we get into a vicious cycle. So, we continue to see a fall in investment, which is going to result in a drop in productivity. Productivity continue to drop down. Prices are going to go up. They can only go one way in that situation. Prices go up, but the overall asset continues to deteriorate, so performance gets worse, and then you start to lose the support of the public. I mean, you know, rail is already, the butt of a lot of public discourse in terms of performance and stuff like that. But imagine if it gets worse as a result of the current situation. How much patience has the public got for the rail industry? We've already, the prices outstrip inflation year on year, so there's a cost issue in the industry. If the performance is getting worse as well in this vicious cycle, ultimately someone will come along. How far are we from autonomous cars? And the pressure to move away from rail will grow. If it's no longer possible to get to work reliably, no matter how much we say we want people in the office, if you can't get to the office reliably, then they just won't go. And we will all continue to work. And we've seen that it's possible in COVID. Overnight we all saw a complete change and transformation in the way that we work. Now, if rail doesn't serve the wider um, society in terms of the ability to get people in and out of the major conurbations, then they're just not going to go, and that's going to have a massive impact on the country. And worst of all is the human impact that this is going to have on lots of people, that career people in the railways that have spent their whole life. And the one thing about rail is when you meet a railway man, they are passionate about this industry. They're passionate about rail.
Everyone is.
People work in rail because they love railways and they love everything that the railways are about. And actually, we face the prospect of an industry that we're going to destroy the lives of these people because we've allowed it to happen. And so, I think we we're on a precipice, and the danger is the relevance of rail could could decline as a result of these things.
Yes. No. So, what are Cartify doing as a business to help others during this time?
Right. Yeah. So it's interesting that I decided to start up a business right on the cusp of this happening. I mean,
Good timing.
unfortunately, I possibly didn't get my timing correct, maybe with hindsight. But I have spent 30 years in this industry, and I've seen privatization, I've seen growth and various booms and busts over that period, and I've worked both in the UK and overseas, delivering rail technology around the world. And I actually think that um, in the last question, we talked about some of the things that suppliers can do to deal with the current challenges. And I think that I've got an enormous amount of experience and expertise that I could bring to bear within the UK rail market to help organisations through this challenging period. Um, so, what I've done in the past is around disruptive product development and creating blue oceans. I did a product development for a company called Knorr-Bremse about 20 years ago to develop a product called EP2002 that went on to be like a global success story. I think Knorr-Bremse have sold something like 150,000 EP2002 systems in 160 countries. So I think I've got experience in how to break new markets and grow rail technology businesses outside of the UK, which I think I can help um, some parts of the UK rail supply chain in terms of getting their technology product offering correct and understanding how to differentiate your solutions. I've also previously I worked for a kind of tier two equipment supplier before it was acquired by Alstom in the um, 20 early 2010s. And we looked at developing a new operating model. So I did a partnership deal with Atkins. So between General Electric and Atkins, we did a partnership deal to bring in new technology from outside of the UK to the UK to help Atkins better compete with the dominant suppliers in the signalling market. So, there's that experience of developing new operating models and commercial innovation that I think I can help people out there to develop win-win product offerings that maybe help them to move up the supply chain and get closer to the end customer and where the money is being fed down through the industry. And then more recently, in the last 7 years, both Jessica, my business partner, and me, we've been working on capability transformation, and particularly in that space of work winning. So looking at developing how to win work, and position an organization and deliver game changing results in terms of tender evaluation. So I think that we can help people in terms of their technology innovation, developing new products and services, building partnerships with the right people within the industry to develop a game changing operating model or a different way of delivering solutions to the market, and then also with your internal capability and building work winning capabilities to better position your products and services within the market. So that's what we can do. Now I'm conscious that as a new business in this space, we probably we don't have trading experience, and so people won't be familiar with Carter Fry, and they're not necessarily familiar with me. So, but I'm confident that as a business, we can help suppliers out there, which is why I've said that I'm more than happy to come in to, I can't do everybody, but certainly to some companies on a first come first serve basis. I can look at your strategy, I can look at the market, and all I know about the overall market, the market dynamics, the market structure, look at your strategy and provide you some advice, some benchmarking about your business, where it sits within the market, how, who you're competing against, and try to help you to shape a strategy that's going to help you to navigate these tough times. And the reason I'll invest in that, and I'll do that up front, is because I'm absolutely confident that I can make a difference. And then those companies will actually want to use me as a paid supplier down the line, which is why I'm prepared to do that. Obviously, I can't do it for everybody, as much as I would love to do it for everybody. Unfortunately, I do have bills to pay, but certainly I am prepared to roll my sleeves up, invest some time and effort into helping organisations to navigate this time, because I think that will pay back for me in the long term, because I think I've got both me and Jess have got an enormous amount of value that we can offer to suppliers at a difficult time.
And we'll put your details down in the comments so that obviously people can get in touch with you. Christian, thank you very much for joining us today.
Thanks very much, and thanks for having me.
Thank you, Christian, for coming on and speaking about the analysis that you've done so far on CP7. I think it's highlighted a lot of the conversations that people across the supply chain are having at the moment, and really putting some data and statistics behind that that demonstrates why they have the concerns they have. If you have any concerns that you'd like to air on our podcast on Rail Industry Connected, then please feel free to get in touch with me on dan.clark, CLARK, at railindustryconnect.co.uk. I'd really like to hear from you. Just likewise, we have actually contacted Network Rail as well, and are waiting to hear back any feedback on them from them based on this analysis so far. So if we hear anything, we will certainly report it, and make sure you're subscribed to the newsletter so that you receive that first. So thank you, Christian, for raising this issue. And as I say, if anyone else wants to come on and have a conversation about the challenges that they face at the moment, I'd be delighted to have you. Thank you for joining us for another episode of Rail Industry Connected. You can view past and future episodes of Rail Industry Connected on YouTube, or listen to them on your way into work on Spotify. And of course, you can connect with other rail businesses and the industry on www.railindustryconnect.co.uk. Thank you, and see you next time.